What's up, everyone? Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And today we're going to talk about ARMs. We're going to talk about the shifting market and some negotiation tricks. Today, this show is for people who are looking at buying a house and you are trying to figure out how to have the competitive edge against other people who are also in the market. Now, the reason I'm coming out hard with this disclosure up front is because if you are that person, this is the one you need to lock into. Isn't every show the one you're supposed to watch? Maybe, but today specifically.
But this one.
This is the one where we're going to go a little bit deeper into like why you should honestly consider an ARM and forget about the ARMs of the past and why you need to listen up to some of these negotiation tactics specifically right now and keep your eye in your local market for what's happening and trending and changing in those spaces. There's a lot of data that's coming out that we're gobbling up, but not all of it is pertinent to your specific town or city that you live in. So buckle in. Here we go. Are you even ready? You're ready. You're ready, right? That's a dumb question. You're ready. Okay, let's talk about ARMs.
I hope so.
Let's talk about ARMs first, Brian. So we're going to talk today about when an ARM makes sense, when an ARM does not make sense. The very first thing I want to tell you, though, is that the ARMs should be used tactically and strategically. They are not a long-term permanent solution. We'll get to all the reasons why in just a second, but the days of old ARMs are not the same ARMs we're talking about now. They may carry the same name, but they are not for the same reason. Back when I was young and it was 2005, 6, 7, 8, ARMs were being manipulated big time. And you need to know that that manipulation tactic does not work in this environment. The way it was being manipulated back then is no longer a road or a pathway to getting you where you need to go. It is specifically a strategy for you to obtain housing now, but with your plan B already lined up. So that's the preface. Brian, where do you want to go from there?
No, thank you so much for giving us that runway and helping the people understand kind of like the context behind ARMs and everything. And also, I encourage people to watch The Big Short so you have a good understanding of how it was happening, because that's technically the best, I'd say, documentary.
If you didn't live through The Big Short and you're younger than me, go watch The Big Short. It sucks.
It's funny that you mentioned that. Not funny, but
it's
a good movie. It's a good movie. Everybody should watch it. So we just brought in a junior LO to start working under us, and he obviously wasn't very aware of what happened in the mortgage industry back then. He's 25 now. So I told him, I was like, hey, do me a favor over the weekend. One of your tasks to do is watch The Big Short. Just watch The Big Short so that you can understand the madness that you're going into, but at a way different level nowadays. But you'll understand a lot of the context when people refer back to 08, 06 in those days.
The Big Short tells a very large story in a condensed movie type time frame. Living through that was crazy because things like pay option ARMs and other very aggressive ARMs were part of the problem because it was qualifying people that actually couldn't make the payments. Part of the ARM conversation historically is that when people were qualifying, they were qualifying with stated income, not earned income.
Yes.
Stated income originally meant income you actually earn, but there's not record for. So if you're a waiter and you make $150 in tips, you are saying that you're making those tips because you do. It did not mean, and it was never intended to mean, if you're a school teacher and you have a side hustle and you say you make $100,000, but you actually make $0, that stated is part of what caused that problem.
And I think that's the biggest part of all this, where I feel like before ARMs had such a negative name on them because people did not know how they worked. And unfortunately, the people that were writing these loans, didn't explain how it was going to, eventually fold out and what was going to happen down the line. So that's the biggest thing, that when I got in the industry, all I knew, ARMs are bad, ARMs are horrible, don't ever do an ARMs fixed rate all the time. And, for the, early part of my career, all we ever talked about was fixed loans. And as of recently, I've been having more conversations about, adjustable rate mortgages, and they've been gaining more popularity. Now, there's a huge difference between what was back then and what is now. For example, there's caps on the amount that the rate could adjust after the period that it's basically locked in for. So that's one safeguard, that before it was just adjusting to whatever the market rate was, or in a very aggressive way.
Well, to those of you who are old enough to remember LIBOR, the London Interbank Offered Rate, that was a moving sliding scale type of rate that was connected to that, which it did have some sort of time caps. However, it's not the same as it is now. So for someone who is looking to buy a house now and you need a lower interest rate either for qualification purposes or because budget-wise, you're just like, hey, I'd prefer to have a lower payment even though maybe I can still afford the 30-year fixed. If you're in that situation and you have a choice, you may choose a 30-year fixed, but you might want to look at a 3, 5, or 7-1 ARM as an option to have a lower payment up front because you know you're going to do something next in real estate. Yeah. Maybe you're moving out of the town you're in 3, 5, or 7 years. So that's one example. Maybe you're on one income now, but your spouse is about to have a job as well in the next 12, 24, 36 months. That additional income at that point in time is going to substantially help your cash flow on your personal budget. But the ARM from now until that point might be the way to go to at least get yourself in, knowing that said spouse will have an income that's being added to the pot every month from that point.
No, I definitely agree with everything you said, Andy. And like you mentioned in the beginning, looking at an ARM option isn't a forever play. It's a strategic move to be able to get in at a more comfortable ability, for whether it be for your payment, for your budget, or just keep some more money in your pocket when you're getting in. And that was exactly one of the examples that one of my clients went into just like yesterday, and I thought it was a perfect example to kind of go over it, where they're in a situation where they're purchasing a house in the ranges of $900,000 to $930,000. But if they go a regular route, which we're doing an FHA loan, 30-year fixed, they have to come in with slightly higher than the 3.5% and then pay off some debt additionally as well. So that being said, that gives them a payment monthly of $6,714 at an estimated rate of 5.625% for a 30-year FHA fixed loan. So the biggest obstacle here, obviously, is the monthly payment, almost pushing $7,000. That's pretty significant.
Crazy.
It's ridiculous, right? So their biggest concern is, well, we also want to negotiate a 2-1 buy down, but in the budget and in the houses that we're looking at, we don't have much room to be able to negotiate those extra credits into the purchase price to be able to get those credits back. So after having a sit down, going over all our options, the buyer told us, hey, we're looking for this, we want to stay under this payment, this is our max. It occurred to me that, hey, well, what if we look into an ARM? An ARM is just an adjustable rate mortgage that is going to be temporary Band-Aid, but it's going to allow you to have a lower rate, have a little bit more comfortability in searching for higher priced houses because your payment's going to be a little bit lower. So we ran the scenarios, and like I mentioned, so for the fixed rate, their monthly payment would be $6,714. But if they went the ARM route and used it as a strategy to hedge against higher interest rates right now, and we wait until rates are below 5%, and it's, makes sense for you to refinance, the market adjusts, there's no prepayment penalty if you refinance before your adjustment period on the ARM, their payment is expected to be estimated to be $6,194. That's a $547 difference a month in monthly payment by basically going the ARM route. So when I explained it to the client, I told him, this is just a play for you to be able to get into your house, be comfortable with the payment, and not have to go, fork out a little bit more money, pay off debt. This way you pay off no debt. You come in with the minimum down payment, and you're able to ease into that higher payment. Or we just hold it out until your rates are at a comfortable spot. We refinance, and then you never have to really go up to a higher rate environment.
So let me ask you, this exact situation you're bringing up here, is this one where they do have a choice between the 30-year and the ARM? It's not just that they need the ARM in order to qualify.
No, this is a situation where they're payment sensitive and they want the payment to be below $6,200. That was their bottom line. That was where they want to be at. And if we looked at it the other route, they would have to come in, pay a significant amount of debt, come in with a little bit more down payment, and their payment is still nowhere near what their $6,200 budget is.
Yeah.
So the play here was more to, get a better understanding of what was the bottleneck, and that's what we did at the meeting. We understood that the payment was the biggest stressor here. So then we strategized what's the best way to still be able to keep them at that monthly at that price range, which is $900 to $930, have a payment that's comfortable enough for them to be able to get into the house while still being able to search for something that falls within, what they want, which is east of the 805.
Well, and you said something else too that kind of is worth mentioning is if you're rate sensitive. Now,
Yes.
The risk in this, and I'll say the risk first. The risk is if you are saying, "Oh, cool, I'll just get the ARM now because I'll refinance later." That's a little bit of that crystal ball we talk about, where maybe rates are going to go back under 5 at some point. I have no idea when that's going to be. You don't either. No one on the internet should be telling you, "Oh yeah, they're going to go under 5 by August of 2020." No one knows that.
Speculation.
Yeah, it's all speculation. Now, the other side of that coin, though, is if you are in a situation where having made the ARM decision today, and later it turns out to be true that you can refinance for a lower rate at a 30-year fixed, then cool, you scored the jackpot. Yeah. That's the goal. I would not advise that you do the ARM hoping that happens. Do the ARM for the situation that you need now, the conditions that you find yourself in, and the timing of how long you need that to exist. And if the market goes and drops into a sweet spot where you can refinance into a 30-year fix that's lower, then you scored.
Yeah, and and one of the safeguards that you have when doing an ARM is that fixed period of time, whether it be 3, 5, 7, or 10 years. That basically means that your rate is locked for that period of time. So as long as you're okay making those payments at that rate for those period of time, you're going to be locked into a payment that you're okay with. Now, the strategy here is that, like Andy said, no one knows when rates are coming down. But if you're, proactive, you're following the markets, you're looking at information, and you're doing your due diligence, which, I encourage everybody to do. But also, don't just take your source from one person. Do your due diligence, dig around. There's a lot of information out there. But if we know that the trajectory of rates in the last 2 years are now, trending down, maybe that could be an indicator for you to, consider this strategy if you're in the predicament of, hey, I want a lower payment. But on the flip side of that, if you're looking to do this to be able to get approved for more because your debt to income ratios are a little bit tight, that's where I would kind of digress, because now you're kind of like going against, what you naturally should be, and you maybe can't afford that. Therefore, you shouldn't really put on that extra debt on yourself. So I think that right now the ARM really helps people that want a lower monthly payment. They do have the option of going both ways, but they're able to understand that it's just a play to be able to have a lower monthly payment and have a comfortable more comfortability with searching at higher price points.
Last thing I want to mention on this topic is that, and it was mentioned on actually one of the recent PBD episodes I was watching, is their comment from the BizDoc was like, hey, listen, when you buy a house and you have your mortgage payment, it's going to cost you more than just the mortgage payment. Mm-hmm. There are things you're going to have to replace. There's going to be things that you want to upgrade. Yeah. There's things that you might want to change or swap out. So let's say your house payment's $6,200, right? Okay, well, the difference between $6,200 and that $6,700 is $500 a month. If you need or choose that $500 a month to go towards any of the things I just mentioned, you have the flexibility to do that.
Yeah, that's a great point.
That is not the reason for us to sell you that loan versus the other one. It is for you to absorb that comment and think for yourself, okay, well, if I had $500 a month or $6,000 a year, what would I do to my garage? What would I do with the loft in my house? What would I do in the yard? What would I replace? What would I whatever? Like if you got an old furnace, you got an old air conditioning unit, you got something that needs replacing, that money's going to have to come from somewhere. And my preference, old man yelling in the corner, is I would prefer you use cash you have for those things versus putting it on your credit card.
Yeah, 100%. And, that's one of the things that, I appreciate about my job is that it's coming up with the best solution for the client that, I didn't right off the bat sold them on the ARM because I knew it was going to be a lower rate because I knew they were going to save money. That's not always the case. But, you get put into situations where you're having to solve people's obstacles. And I wouldn't say problems because there's obstacles that you get over them. There's ways to be able to, get that all taken care of. But I thoroughly enjoy being able to then come up with this solution and not telling them, hey, you need to do this. Like, hey, guys, have you considered this compared to this? And I gave them both of the options. Like they could see what their ARM, see what their fix looked like. And, ultimately let them make the decision, but give them the options. And I think that's one of the key things that a lot of people are looking for right now is to know what their options is and know that they have options. Yeah. But when you don't ask and when you're not, putting yourself in that situation, you got no options. So I encourage people to, go and find out what your options are.
And if this is your only option, then it's the one you got to consider. And if you are uncomfortable with that choice, don't take it.
Yeah. 100%.
If this is your only option, and you like that choice for yourself and for the future you're pacing out, then take it, run with it, go get a home.
100%. So, just because you feel that you're capped out with the, rates being so high, there's light at the end of the tunnel. There's strategy. So whenever you're meeting with the professional, you're getting pre-approved, ask them what other routes are there, and, get a good idea of what all your options are. Don't count out that arm. Just consider it. See what it looks like.
Now, this topic is kind of like hand in hand with the next thing we have to talk about today. Topically is, I said topic a lot, is are we in a market that's cooling down or heating up? I mean, this has to do with inventory, house prices. There are a lot of shifting sands, as they say, in real estate, depending on what pocket of the country you're in. Some areas are, I'll say, much more vital and healthy than others. There are some that are really under a lot of duress right now.
Yeah.
And I think that some of the notice of default things I'm reading and hearing about and watching are months delayed, which means that there's probably more coming up, but it's like popping up in some areas way more than others. A lot of that has to do with the area and the economics of people being able to pay, like their job and their equity or whatever. Very simply stated, if you are if you're delinquent on your mortgage and your house has equity, list it and sell it. If you're not going to get out of it, don't risk the foreclosure to save your to save face. Don't go 60, 90, 120 days late on some vanity quest to just lose your house ultimately in the end. If you have equity in your house and you can sell it now, put that damn thing on the market and sell it. Okay? That's what I'm going to say.
Yeah,
so
straight up. Thank you for ripping the Band-Aid off.
Hot market, cold market, the ARM conversation kind of weaving us into how do people play this market? What kind of shifts are you looking at? What are you seeing? And how are you advising people to navigate through them right now?
Yeah, so we're definitely seeing a lot more inventory. I think we're up 20% from last year. So that's causing a lot more people to have more options. So nobody's really kind of running and, trying to get into houses right away. So that brings a little bit more ease into the market. But the thing is that it's all hyper localized. So depending on where you're at, for example, here in San Diego, we're still seeing very, very quickly the houses, get gobbled up off the market. So in this instances, you still have to be very strategic. And I think it's, understanding the market that you're in, understanding that you're probably not going to get, a low ball offer accepted. And I think right now is just the perfect time to get in. And I think we always say that. And, a lot of people say, oh, well, you're supposed to always say that. But what I'm strictly seeing right now is that a lot of people are going into the market because they are seeing rates are coming down. They are seeing more houses on the market. But what people don't understand is that we're still in the beginning phases of the year. Spring hasn't really kind of came around. Summer hasn't come around at all. So when those months hit, and if we're seeing the rates, do what they're doing and holding their place right now, but come March, these last 3 years, we've seen a lot of movement in rates when that month comes around. So I'm speculating that based off these 3 years trajectory, it's gonna happen similar. So something's gonna happen in the springtime, which then I digress and say, start now so that when the madness gets here, you're already cruising. And I think we're talking about going 100% earlier. Some people are been going 100% already.
Yeah.
And we've been doing it for 6, 10 a year. The people that get in and go 100% that day are already going to be behind because people have already been at it or been understanding how the things are moving.
Yeah.
Starting to ramble on that.
No, you're fine. Well, look, we have to talk about these things and with context and depth because not every situation is the same.
No.
Neighborhoods are different, counties are different, zip codes, locations, local demographics, economics, the whole thing. What I want to kind of take away from this is that there are some things that are starting to reveal themselves in the mortgage market inside residential real estate. Yeah. Number one is that people who are hungry for homes are real hungry. Mm-hmm. If they were kind of a little bit hungry earlier, like for a snack, they're starving now. They are trying to get in and they're doing everything they can in order to get a house. Now, then the next question from that is, well, are bidding wars back? Not necessarily. It depends on what you're bidding on. So this is the difference in inventory. Hold on, because I know you got something to say about this, but this is what I've been seeing. There are places that used to be on the perimeter of the main metropolis. And those places were heavily sought after. They're less dense. There's less traffic. It's a little more country. It's a little more wilderness. It's a little more land. A lot of those places are on the market for many more days than the central houses and getting less offers than the centrally located homes. The ones in the city and the suburbs I do see multiple offers coming in. Now, I don't mean multiple like 50 or 40, like 2 or 3. That's still 2 or 3 other people you're in the ring with trying to duke it out for whether or not your offer gets accepted versus somebody else's. So I'm prepping all that to say, while it's still February, and before we get into the spring months that Brian's talking about and the summer months you're talking about, is understand your position in your market so that you know going into making a deal and negotiating a deal, what you need to ask for, what you need to offer, and what are the maneuvers you can make versus being shoved up against the wall by the demands of the sellers. You got to know your lane, pick it, and pick your spot where you can attack and go.
100%.
What were you going to say?
No, I was actually follow up to that. So one of the things that I've been seeing a lot is a lot of communication, and at least the offers that get responses or go into multiple offers or even get accepted, is that the agents, the clients, are having a lot of communication with the other side, and they're asking those questions. What are they willing to accept? What is their terms? What's their biggest stressor? Having enough information on the selling side to know what offer you should submit instead of submitting blindly. What I've been seeing is multiple offers, but not in the sense that people are just throwing offers hoping that they stick at the wall. Mm-hmm. They're very strategic and strong offers. So like some offers that we get beat out, they tell us, hey, it was a close race. All you guys set in good terms, but they came in with lower contingencies. They came in with the faster closing. They came in with no asking for no credits. They came in giving us a rent back. So my thing is that whoever's representing you, and if you're the buyer up front, know this information and know what it is, what data points you need to ask the other side so that the offer you send gets considered. Because it's not the time to be sending offers with emotion and saying, hey, I feel this house is worth this. Back then it should. No. You need to fight with facts right now. Pull up numbers, pull up comps, pull up all the information that you can gather from the sources that we have at our disposal to be able to then get an offer out that has a backing with actual facts and strong knowledge.
Okay, so then let me ask you the question from like the front lines. Like, which homes are the ones that you see bidding wars happening in, and which are the ones where you see that people aren't having to like struggle so hard to get their offer accepted? So what's the difference?
I'm so glad you asked that. Right now, the sweet spot in the houses that I'm seeing that are very competitive is that 750 to like 900 range single family residence. Why? Because a lot of people want a single family residence. They want their own house. They don't want to be in a townhouse because maybe they're moving out from that townhouse that they lived in 10 years. Or maybe they want to size up from that house that they bought 4 years ago in 2020 when it was their first time getting it. That's another conversation we'll get into. But what I'm seeing is that range is very competitive. And that's where I'm seeing that if you're asking for credits, you might get, disqualified from being a contender for that offer. That range is where I'm seeing a lot of competition. And then it starts easing up when you're below the 600 townhouses, condos. It's a lot more easier because there's not a lot of competition. There's not a lot of people that want those types of properties. Although there is still heavy competition on them, SFRs is what everybody wants. I made another comment that a lot of people that bought their houses maybe 2, 3, 4 years ago, I'm getting a lot of calls from my past clients looking to upsize. Hey, we don't need that much room anymore. Or hey, we just had more kids. We need to have a bigger house. So there's also a wave of people that are looking to upsize this summer and this spring. So keep in mind that golden handcuffs for some people are going to be coming off in these spring and summer times because rates are going to be finally at the levels that meet their thresholds for them to make a move. Mm-hmm. Maybe it wasn't 7, maybe it wasn't 6, but now that we're flirting around with that 5 range, hey, that can unlock a lot more people that want to make moves.
Okay, well, so let's talk about the other kind of like the thing that I see floating around. It's like home prices are falling, and there's listings that were on the market that are closed. The data's coming in that they are closing at less than what the list price was.
Yes.
I know that there's regionally specific numbers depending on where you're listening to this show from. But let's talk here just because it's our backyard. What are you seeing as far as house prices in San Diego? Are there areas where you're like, oh shoot, that's 10% lower, this is 5%, or this is like exactly at the same listing price that it should be? What's happening out there?
So I would say in the eastern part of Chula Vista, we're basically seeing prices hold. A lot of people want to come down here, but I'd say different pockets, like Eastern Chula Vista, like Eastern San Diego, like over in the Spring Valley, El Cajon area, those are, starting to, come down a little bit in prices. Mm-hmm. But the hot areas, those have been holding their prices for the most part. So like your La Jolla's, your Bayhos, your Claremont's a hot area that a lot of people want to move to. So I see prices staying pretty pretty close to the levels they're at right now. And the only thing that I feel that might change that is if come around March, spring, summer, rates start to come down, a lot more people start listing their houses, and then there's going to be a frenzy of people wanting to, start making moves.
So my paper analysis, and I'm saying paper analysis because I'm kind of looking at data. Something that struck me, what day was it? Like maybe it might have been Monday or Tuesday. What struck me was the type of land it had. What I'm seeing is the houses in like Claremont, Kearney Mesa, Bonita, Spring Valley, El Cajon that have room for an ADU are holding. If the home is a townhome or a condo, there's no expansion, there's no possibility of cash flowing that at all. Those are the ones I think are getting dunked on pretty hard.
Yeah, you're coming in and asking for whatever you want.
They're on the market a really long time. My sister-in-law, she had a 1-bedroom, 1-bath condo in Mission Valley that was on the market 4 months. It was in and out of escrow. And what kept happening is people were like, well, wait a minute, if there's a dollar amount, I actually going to go over here and do this instead. And so that's kind of one thing that's happening. But so when you're in a fixed constraint situation, so this isn't necessarily part of city, it's more property type. If you're like a fixed constraint situation, townhome, condo, that is going to have a limitation to what you can do cash flow wise on that. Or basically, maybe even none. Which means then the market's going to be harder on those sellers right now than the people who have a 1/4 acre or a 1/2 acre, even in a suburb that allows for an ADU or an ADU and a garage conversion. Those types of places are being sought after by investors, long-term buy and hold people doing the move up, multi-generational living where you got to bring in an old parents or whatever it is. Those ones are holding value because long-term, it's going to create cash flow and offset for the expense of you buying it at this market price.
I would say, and I agree with that totally 100%, is I would say that if your property is sitting on a 5,000 plus lot and you have anywhere, some space.
5,000 square feet or more.
5,000 square feet. Did I say 500?
No, you said 5,000 lot. Like people don't know. Like you and I know what that means.
Sorry.
5,000
square feet lot or more, you probably are going to get, a lot of people that would want to buy your house because I work with a few wholesalers that send properties, and one of the things I notice on these value add properties is that they don't budge on the price. Why? Because they know the value that's worth down the line. So they're sticking to what their price is, and if you don't want to buy it, there's an appetite for it that somebody else is going to come by and buy it. So what I've seen is that people come in tiers. If that doesn't appetite that investor, somebody else is going to come and get it.
That's correct. That's the thing is if you don't, so
someone
else is. And here's the signal from again Uncle Andy yelling in the corner. They have this term that we've talked to you about on the show before, ARV, after repair value. If anyone's coming in and they're making their decision based on ARV, they have a formula for buying that place right now, and if it pencils out, they're gonna do it.
Yes.
So the signal is anytime someone's talking about ARV and this and that, guess what? You're talking to somebody who's not looking for a 30% haircut. They're gonna probably come in and buy it in and around where it needs to be, where it is right now, where it needs to be to close quickly, so they can get that cash flow going as fast as possible.
Yes, and the play, what I've seen them do is they'll start in phases. They'll get something going. They'll get the main house rented as they're working through the other things, and it's moving along as they're building and doing the work and doing the repairs and adding whatever they got to add. So if you don't buy it, someone else is, and that's one of the things that I've been seeing. Somebody else's trash is somebody else's treasure, and that's one of the beautiful things here about San Diego, that there's multiple types of properties, multiple pockets of area where you can diversify yourself however you want in, whatever type of investments you want, or just pick a pocket of the city that is going to have a good shot of appreciating in a way that you like.
So this goes hand in hand with the last thing today, which is kind of the strategy of negotiation and how to get into a deal right now, whether it is a condo or a townhome, or it's one of these places we're talking about where it's a value add property and someone is looking at ARV. How do you go and compete right now, Brian? Like there's so many different ways to skin a cat, as the saying goes. But like I want to, even though we're talking about like price for a second, I know price isn't everything. Now, I also am a consumer, so price is important to me.
Yeah.
However, I'm also in business, and sometimes terms and the deal and the whole totality of the deal is more important to me than just the price of today, because I got something else happening 12 months from now, 12 years from now, or whatever. So talk about the difference between price and like deal structure.
Yeah. Okay. Perfect. So one of the things that, I notice right now is that we're structuring deals more strategically than ever, meaning that we're taking into consideration everything that we're putting on the contract, because the last little thing, the last little number could, make a big difference. And I've seen it where right now the biggest thing is you have to understand what the other side's stress, pain points, or what their goal is, to be able to come as close as possible to be able to meet them in terms of your offer. So the conversations I'm having right now with clients is, do your homework, understand the property, utilize your inspection reports, utilize past comps. But the biggest thing here is aligning yourself with an agent that's tenacious, that understands the market, that knows how to negotiate, that isn't just sending offers based on what you're telling them because they're the experts, you're getting, led by them. So I think as the buyer or the seller, it's your responsibility to do the homework, to ask the right questions to the person that's leading you. For example, asking for credits, but ask if the seller's willing to consider that, not just ask for credits and hope that they give it to you. Ask for lower contingencies. How quickly can we close the loan? How quickly can we get the inspection? Appraisal, we don't, control them. So, we hope that they get it to us back as soon as possible. And the last one is, there's this type of a negotiation I've seen that helps buyers beat out offers when they're in multiple offer scenarios. It's called a bona fide escalation clause. Only some realtors I've seen done it, and I think it's a very smart strategy. And essentially the way that it works is, like, let's say you send in an offer at $950 and you add that escalation clause and you say, hey, we're willing to escalate our price point $5,000, $1,000 above your highest offer that comes in, as long as it's bona fide and basically prove that that's what it comes in at. That gives you leverage because you're already putting in place measures that helps you get ahead in the event that an offer comes in that's higher than you. And then it just makes you aggressive in the way that it's going to trigger the seller to perhaps send you a counter offer. And then now you're in negotiations.
I didn't know you were going to say that. As you were commenting that, I wrote have an option A and an option B. So I'm glad you mentioned that because there, part of it is, yes, this is what I want. So I'm going to ask for what I want. If I don't get what I want, what is my move from there? So think like chess. Think 2, 3, 4 steps ahead. Even if you're not good at chess, you understand the theory I'm talking about. You have your move you're making now, but have your next move after that and maybe another counter move after that ready, so that if you really, 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 really love a place, you have some space to be flexible in what you can do with the seller.
Yeah.
The sellers in most or all situations are never going to talk to you. Yeah. It's going to be their agent talking to your agent, but you've got to think through what they're considering when you sit on the other side of the deal and you look at what you're offering and you look at that if that's enticing or not. If that's not enticing, then what's your plan B? Like, what's the backup if they say, yeah, no, just no explanation, no. Or how about we do this instead? Then you have to be ready to know, okay, that meets our test of what we'll still say yes to, even though it's not the thing we originally said we wanted at the front. So having option A and option B, I think, is critical because stubbornness should not work you out of a deal. I know that the inclination is, well, this is what I want. I'm going to pin that seller up against the wall. That doesn't always go well. If the seller's in a situation where they've got a cave because they're pinned up against the wall because of something else, regardless of you being the buyer, that might be the real reason that that's happening, not because you're just pushing them up against the wall. But also go in tactically versus just shooting from the hip. Be flexible and be creative so you can make a deal happen where both parties can successfully close this.
Yeah, and to add on to that, I think 2 clarifying questions you could be asking your realtor is, how many offers are we realistically competing against, and what terms matter to the seller the most? Knowing that information could bring a lot of clarity, and I think it's just understanding, and like you said, I think you couldn't have said it any better, putting yourself in the situation of the seller and saying, hey, would you accept an offer like that?
Yeah.
Would you accept that offer in a house you're selling? Especially if you're a repeat buyer. I mean, you know what it is to sell a house.
Yeah.
Hopefully. But, would you accept that offer? And I think it's being realistic and leaving the emotions in the back and acting with logic and sometimes just, taking that action.
And maneuverability, I think, is the word I'm going to use to kind of solidify my approach to this and my conversation in this section is maneuverability. Like, okay, you won't come down on price. Can you come up on credits? Or, oh, you don't want to give credits, then can you come down on price? Like, have levers you can pull and buttons you can push so that you're tangoing together some sort of deal that's gonna work. You can't do that by being stiff and rigid. I mean, well, hey, you know what? Prove me wrong in the comments. If you've been stiff and rigid and it worked out for you, let me know, because I'm willing to bet on the other side of that deal, someone got their back against the wall. Other than that, I'd say be light on your feet, be flexible, and have maneuverability when it comes down to negotiations. Anything else, Brian?
No, honestly, for me, the 5 things that you should probably just look after this year is don't rush to buy, but also don't hesitate forever. Buy within your means. Budget beyond your mortgage, property taxes, insurance, HOA. Plan 3 to 5 years ahead, not in just buy tomorrow, and have a rate strategy. Yeah. If it's a high environment for your rate that you're getting, just know how you're going to get out of it, and plan and look forward to that.
Yeah, I only want to say one thing about all those topics is, as much as possible, do these things unemotionally, or with limited emotional influence, because it can really screw up the way you think about things if your emotions are at the controls, versus making sure that you're actually getting yourself in a situation that's going to be useful for you and your family long term, or for your long term financial plan. If it's not with the family, then it's just on your own. And again, I understand emotions play their part, and emotions are worthy of being expressed and shared. There are also situations where they can be running interference with making a good choice. And I guess my advocacy here is, if you can, temper those emotions while trying to make an important choice. Let the important choice be predicated on the things that you know you're willing to live with and tolerate while going into homeownership, rather than just the excitement of homeownership being at the control and then forcing you to a situation that's really bad or puts you in a lot of duress because of the decision itself.
For my millennials, be logically emotional, which means understand your emotions, but go with the logic.
Yeah. Well, great job today, Brian. I have not asked you recently, what was your favorite part of the show today?
My favorite
tell me.
Part of the show is, giving people a perspective of adjustable rate mortgages, that it's not a bad thing, that it could help you, that it could be the strategy that gets you into your house, but understanding how to utilize it for your benefit and not being afraid of it, because we're afraid of what we don't know. So now you know that it could help you gain a little bit more purchase power, have a little bit of a lower monthly payment, and maybe give you comfortability in the beginning years of your mortgage.
I'm going to go with the shifting market today. I am very intrigued, and my eyes and my ears are attuned to what's happening around specific cities here in San Diego, even some that I'm trying to get out to myself and for my next move, because I think that there's going to be some real opportunities in the spring and summer. Yeah. Remember that despite whatever might be happening economically, there are, to quote my friend Miguel Contreras, the 3 Ds of real estate: death, divorce, and debt. Any of those Ds at any time could be a cause for someone to have to put a property on the market, regardless of whether it's the right time or not. So remember that those things are always happening. We also have a shifting market of where people are moving and where they're moving out of and where they're moving into. And I really do believe that some places that came off of the market in the fall and the winter are going to come back on the market. Yeah. People that got their listing expired, or like, you know what, it just didn't sell, I'm going to come back later. I'm already kind of hearing some of these behind-the-scenes murmurings that, hey, we took our place off, but it's going to come back in March,
April.
April.
People that saw, let's see what we could get for it.
Well, it didn't work out. And in a couple of instances on some places I was even looking at myself where I'm like, I know they're over the market, but they're trying to list and sell their house for the buyer of 2022, but it was 2025.
Oh, yeah.
That's
a whole other topic.
I think, but I think when my point in saying that I'm choosing the shifting market topic today is because I think those properties are going to come back on the market at the right price in the spring.
That, and just knowing that the market is shifting, my phone's been ringing a lot.
You go, yeah. Dude, you sit next to me. My room is sound treated, and I still hear you.
These last week, I literally been on the phone. Like I was telling Anthony, I'm like, I can't even actually do my work. So I get a call, then I gotta go do that, and then I get another call, which is great, is what I'm saying.
No, when the calls pick up and the emails pick up, there's activity happening. That's motivation and momentum happening in the lives of people that are looking to buy and sell real estate. So good job, Brian. Thank you all for watching. Remember to share this with somebody who you know who's been talking about this, whether it's been talking about ARMs or the shifting market or talking about negotiation strategy, whether you're in the market to sell, you're in the market to buy, or if you're a realtor, you're in the mortgage real estate business. We want to hear from you too. Yeah. We're gonna continue kind of shifting some of the things we do here on the show into and through 2026, as well as do some other segments and pieces that are a little more I'll say targeted for the people we can help best.
Yeah.
And so we do want your input and your feedback. Thank you so much for watching and supporting the show. And if you need to reach Brian or Will or myself, you can find our contact details on our website. And we will see you with another great show next week, right?
Yep.
Okay. Thanks,
Thank you,
guys. See ya. Bye.
If you like this video and like to subscribe, click here. And if you want to watch other videos, click here.